Oh, hey, everybody. It's Brian Castle. Welcome back to the Financial Advisors Workshop and the Today's Market Explained 4-Star Media. We call it the Media Network now. We're going big time. But thanks, everybody, for joining us today on Today's Market Explained. Today, we have an interview episode with a very interesting character, a good friend of mine, Laine Schoneberger. Laine, welcome to Today's Market Explained.
Thank you. Pleasure to be here.
Well, great. Well, Laine's going to talk to us all about what's going on in the student loan market in a company that he's launched that does support for student loans and how we do all that. But, you know, Laine, before we talk about all that, you're really one of us. We're financial advisors, and you were for a long time a financial advisor.
I was, Brian. I spent 25 years as a financial advisor, independent RIA. Back in the day, you could do everything, right? We did insurance, investments, and estate planning, and it was a great career. I enjoyed every second of it, and I loved those clients. I came into the family business that my dad started back in 1968. So, you know, it was not an easy thing to decide it was time to retire and move into this business, which is Yrefy. And, you know, it actually starts with a little bit of history in that in the business of financial services. My partner, who's the CEO of this company, he was one of my very first clients back when I was just an infant in the financial services business. I was introduced to him. It was a true garage story. I was literally introduced to him in his garage. Yeah. He was looking for benefits, right? And back in the 90s, that's what you did to attract and retain employees, was you put in the benefits. So I came to the table and I did all of the benefits, and next thing I know, I'm running all of the executive deferred comp and health and dental and vision and retirement plans and all the things that we as financial advisors did back then for a company that became, well, it was the third largest privately held student loan company in 2006, 2007. It had over 1,000 employees, and they were funding $1 billion a year in production, and he built an absolute machine. 2008, 9, just cleaned out that entire market. This leads into the discussion about Yrefy and, frankly, how Yrefy became a thing. And long story short, in 2007, the total student loan debt load in this country was about $685 billion. It wasn't, that sounds like a lot of money. However, in today's numbers, that's actually not a lot of money.
Right.
The government under Barack Obama ended what was called the public-private partnership, and it essentially put every single company out of business, where they brought all lending back into the Department of Education. This was, in essence, the government opening the proverbial purse strings, if you will, at which point in time the student loan debt exploded. And as we have it today, it's currently sitting at about $1.8 trillion. Now, what's interesting about that student loan debt is 100% of it is bankruptcy protected. So these borrowers do not have the ability to walk into a bankruptcy court and just BK out and walk away. Right. There's two sides to the student loan problem. You've got the federal student loans, and then you have private student loans. And now federal student loans are made under the federal government auspices. This is the debt that you hear Biden talking about forgiving. All right. Mm-hmm. And I'm just going to say it right now, so we get the 800-pound gorilla out of the room. We only deal with this with private student loans. We only deal with distressed private student loans. So the federal government cannot forgive private student loans. It's not their money to forgive. Now, when I say that, because we tend to lean to the right on this, in our company, I'm not going to lie. And what ultimately happens is the discussion of, well, does he really have the right to forgive any student loans? And the answer is probably not, as evidenced by the Supreme Court decision that just happened. So we're not terribly concerned about forgiveness because it really doesn't affect us. And frankly, if they did manage to get any kind of forgiveness through, it would actually help the company and help our investors, which I'll explain more about in a moment here.
Sure.
So we only focus on private student loans. Okay. And of that $1.8 trillion of student loan debt, we're focusing on the private student loan side, which is distressed, which in January of 2017, when we started the company, we knew verifiable was a $21 billion with a B, $21 billion market. What's interesting is most people don't know private student loans are almost all variable interest rate loans.
I see.
People people are just getting destroyed right now, completely just decimated. Our market in the last 16 months or so has exploded to over $45 billion. So it has been an absolute tsunami. And Yrefy is the only company in the country doing what we do, helping these borrowers actually get out of debt. And the investors win by being a part of it.
So Laine, I know that the government's always been involved in some sort of student loans, but then after that takeover by Obama, prior to that a little bit, however, wasn't there a major expansion of loans from the federal level? I remember in college, it was not easy to get loans. And then recently, the last 20 years or so, it had been easier to get loans. And basically everybody had to go to college. Well, maybe everybody doesn't have to go to college, but they were throwing money at people to go to college. So we've got this huge debt problem now, don't we?
When the government got involved, Brian, that's when things got really ugly. Okay, they opened up the purse strings, and what ultimately became a problem was whenever you have basically a free access to a money supply, what are you going to have? In Keynesian economics, right? Money supply goes up, prices go up. Or, the schools started with this.
No surprise there.
No surprise. And college inflation rate outside of normal inflation has been over 10% a year now since 2008-9. So, there's no end in sight. Then you add in normal inflation, this is normal, the current inflation outside of the college inflation, and it's becoming unaffordable. And you've got people coming out of school with degrees, and a lot of them are actually good degrees. We often joke about, somebody coming out with a degree in underwater basket weaving, and they cannot go out and service that debt. We see people coming out with actual degrees where they can get a good career, and they still cannot service the debt. It's just too much. And now, you've got with interest rates going up, you've got your white collar, your doctors, your lawyers, your dentists, your people with higher debt. They're coming out, they've got a career, and all of a sudden, a payment that was $1,000 jumped to $1,500, then $1,800, then $2,100, and $2,900, and all, because these things adjust either quarterly, semi-annually, or annually. So come January, which is right around the corner, we're going to see another tsunami of people going into distress. Add the fact that today, September 1st, the federal student loan portfolio interest starts to accrue on those borrowers, and in October, payments begin. There's going to be about 40 million borrowers coming back into the payment structure. Half of them don't even know who their servicer is. They don't know how much they owe. They don't know anything. There's a predicted 50% default on the federal portfolio coming. And of course, that'll start to trickle in from October, probably through December. So January in the education finance space and the collection of that federal portfolio, in addition to the interest rates having gone up, I can't even begin to explain the size of the tsunami that's coming in 2024 on this problem, which is great for Yrefy, bad for the country.
Bad for the country. Well, and so, from a policy perspective, maybe we offered too many loans to too many people without any real sense of what they could get from it. And so we saddled a whole generation of people with loans, them thinking it would help them long term. And it was really more for the companies who are offering the loans and the government control and a lot of other forces out there that really had nothing to do with college and loans, for politics or something like that. But either way, we got this big mess on our hands. And so how is Yrefy now helping individuals in the private, not this government loan, the private loan market?
Correct. So, that's a great question. And really it comes down to, at the end of the day, it's capitalism, right? It's the private sector stepping up to fix a problem, find a need, fill a need. That's what we've done here. And what we do is we work directly with these borrowers. So I'll give you the quick high level how we help borrowers. Remember, all these borrowers are in distress, so their credit is generally not in good shape. And I'll give you some statistics as I explain this. About 70% come with a co-borrower. So mom, dad, grandma, grandpa, someone has signed on the line with that borrower. And again, they're bankruptcy protected. So they're looking for a solution. And at this point, they don't have one. The solution is debt collection. So collection agencies, threats of judgment and garnishment. And those are the solutions. So what we do is we interrupt that pattern, right? Everything we do, borrowers are calling us. They're referred to us through resources such as Dave Ramsey. He endorses Yrefy on the borrower side. We do a lot of Google pay-per-click and direct mail to borrowers. So they're calling us. We don't do any outbound phone campaigns, no robocalls. That's not us. They call us. We explain the process. A lot of these people, by the way, they're upset, they're scared, they're nervous, they're embarrassed. A lot of them are crying on the phone. I mean, it's a bad situation these folks are in. Mm-hmm. So a lot of consultative calls. Explain our product. We do an application. Now, the process we put them through here, Brian, is very similar to getting a mortgage. We are going to underwrite them in a very similar format. Here's the difference. And by the way, mom, dad, grandma, grandpa, they're going through the exact same process. The difference is we do pull credit, not because of their FICO score. We do not underwrite on FICO score. We know they have a bad FICO and we know why. What we want to look at is the human element. Okay. And at the end of the day is, can you afford the Yrefy payment? Yes or no? And as we pull that credit bureau information, what we're looking for is the ability to calculate their debt to income ratio, right? We want to know where you work, how long have you been there? We want to see tax returns, all the stuff you would normally do in an underwriting process. But we want to see the debt to income ratio. We then require that borrower to set up and start making an escrow payment to us to prove to us that they have the willingness, more importantly, the ability to pay us back, right? Now, during that process, we're going to require them to do that for a minimum of 2 months. Okay, we want to get establish a relationship. We average about 6 months while we're doing this. Now, during that time frame, what we're doing is we're working with the existing lender, servicer, collection agency, law firm, wherever the debt may be, and we're negotiating the price, getting it down as low as we can. We ultimately settle out and pay off that debt somewhere in the 35, 40 cents on the dollar range. Okay, sometimes much lower. We're seeing a lot of good pressure on the pricing these days, so the prices are starting to come down. However, let's just call it 35 cents for the sake of conversation. We then refinance that to the borrower at 100%. We do not give them a discount on the face value of their loan. And I'll tell you why in a second. We then add in our 5% refinance fee. So the borrower actually owes us 105%. The difference is we give that borrower a low fixed interest rate and a custom term built around their ability to actually make the payment, right? Now, we get asked all the time right here, Laine, why don't you guys give them a discount on the face value of the loan? I mean, I'll give the example. You bought a $100,000 loan, you paid it off for $35,000. Why don't you help the borrower out a little bit and maybe take from 100, take it down to 60,000, knock $40,000 off the top. And the reason we won't, and the reason we won't is because if we do, that borrower gets hit with what's called a cancellation of debt income tax, meaning that the higher amount forgiven in that year is taxed as ordinary income in the year in which it's forgiven. Okay. Well, now the borrower's got a bigger problem. They got the IRS breathing down their neck. So we don't do that. So there you go.
So you protect them that way.
Right.
So you say you can't dispatch student debt in bankruptcy. So this is with you forever.
Right.
So have you seen people who have gone through this process and gotten their life back on track?
Oh, yes.
Good.
I one of my favorite things, Brian, is I get to do the borrower testimonials. I mean, it fills my cup. And if you go to our website, investyrefy.com, the borrower testimonials are there, and they're real borrowers, they're real stories. And I get a little choked up talking about some of these folks because I get to talk to them after they have been kind of recovered, if you will, right? I'm not talking to them on the front end. I'm talking to them well after. Sometimes it's a year or two after, just to check in and get that testimonial. Life-changing. I mean, there's stories in there, and you'll hear them. I listened to Amanda, and if you go back and listen to her story, you hear where she's talking about, thank you probably saved my life. And I'm not kidding when I tell you, we were on the phone for an hour and a half, and she was elaborating on what that looked like. And I'm not kidding when she said, you probably saved my life. She was not joking about that. This is how bad this problem is. Okay. People are giving up hope because it's literally it's crushing them. Right. Watching people win has been a huge, huge benefit. And frankly, our borrowers are doing so well because a lot of people ask us, well, Laine, how are your borrowers doing? We're coming into 7 years in the business here pretty quick. And our default rate amongst all of our borrowers is under 2%. They're doing ridiculously well.
That's great. Well, so in a sense, you're doing, you're doing well by doing good. In a sense, you're running a business to support people. Obviously, it's a business that is profitable, but you're helping them get back on their feet. So why Refi? Oh, and also you didn't mention Larry Elder. Is Larry Elder involved with you also? Who was a famous radio host. He ran for governor in California. He's running for president.
Oh, he is running for president. In fact, he joined us in Nashville. I was just there yesterday meeting with Dave Ramsey and his team, and Larry joined us in Nashville. Larry is a huge fan of Yrefy. He loves what we do, how we do it. And it's just having him as a part of our I'm going to say part of our team, because frankly, he feels like he is a part of our team. He's an endorser. He's an investor. He understands everything that we're doing from top to bottom, and he really gets behind it. And that's led to some other very kind of neat, fun endorsements, from Sean Hannity to Clay and Buck to, Jesse Kelly. I just got word that Glenn Beck is on board, so hopefully we'll hear from him pretty soon. As far as his copy, he wanted to write his own copy, which thrills me, right? I would rather they write their own copy as opposed to reading all this.
I think that's the fact that people see that you're in a company taking investors, but you're doing well by doing good again, for the public, which is a great thing. It's a big problem, and the government doesn't have a solution for it, really. Biden's just trying to, forgive everyone, and that's more politics than anything. But you're trying to actually have people solve their problems, pay their obligations, and do it in a sensible way. So that's a good thing. So now you talked about investors, and I'll say this to all of our listeners: if this is the right investment for you, you should talk with your financial advisor to make sure that it is right for you and for your portfolio as part of a diversified portfolio. And so you could talk to someone at 4-Star or your investment advisor wherever you are. So that's for our listeners. So, Laine, how could investors get involved if they chose to, and if it was right for them?
Well, like you said, start with your financial advisor. The interest rates that we are paying are net to the investor, regardless of whether you have an advisor or not. It's the same. At the end of the day, what we would encourage is you sit down with your financial advisor, have a conversation, make sure that we are a fit. What we offer is something rather unique. And can I explain the investment side of what we do, Brian? Is that acceptable? Please do. So if you don't mind, I'm going to share my screen really quick, and this will allow the ability for you to see what it is I'm doing here. Share. Sure thing. So what we have here is this is what we call our tear sheet, and it explains a little bit about the investment itself. And what I would like to show, okay, so this is filed under what's called Regulation D 506C. What that means is we're filed with the Securities Exchange Commission as what's called an exempt offering. Okay, that means it's not publicly traded. Okay, the 506C, at the end of the day, it allows us to advertise. Minimum investment is $50,000 and accredited investors. Now, if you're an investor and you don't know if you're accredited, ask your financial advisor. What I'm looking for is I do have to have something on file that says you're accredited, and your financial advisor can provide me with a very simple one-page letter on their letterhead that says you are. I do not need backup supporting documentation if they're willing to provide that. Now, what we did, Brian, was we created something rather unique, and what I mean by that is we've created a kind of a tiered ladder. Okay, and this comes back to my experience in the investment advisory world, building investments for clients where, you could create a laddered income and so forth. So on the front end, it's structured a little like a bond. I have to disclose they're promissory notes. They are not bonds. Okay, I'm comparing them to that only because mechanically they function like that. So you as the investor or your advisor, you pick the duration of your investment from 1 to 5 years. The interest rates illustrated, these are fixed interest rates in what's called a secured collateralized portfolio. I'll explain what that means in just a second. Mm-hmm. What we do is we calculate interest on a daily basis, and we make monthly payments of interest only to the investor with a payback of their initial investment at the end of the term, kind of like a bond. Again, they're promissory notes, but they function mechanically in that sense. Well, then we said, let's give the investor or the advisor on behalf of the investor the ability to control that income, because there are some clients who say, I don't want the income. Can I reinvest it? Can I compound it? And the answer is yes, you can. In fact, what you can do is in each individual term or tranche that you have money invested in, you can turn that interest income on or off, up or down in 1% increments or by dollar amount as often as monthly. So you have complete and total control over the investment, right?
Great.
I don't know if there's anything else out there that does this. It's pretty flexible. We built all of it.
So there's different years. You can pick a particular year, and then that's your rate.
Yep. You pick the duration. So I always use the same example. Let's say a client puts $100,000 into each tranche or each term. Client says, I want to make a smart decision here. I want to take the income from the 1, the 2, and the 3, and I want to compound or reinvest the 4 and the 5. You can do that. Next month, client says, I need a little more income. I'll take the 1, the 2, the 3, and 32% of the money from the 4 year and compound the balance. You can do that. Next month, client says, I don't need any income. Let it all reinvest. You can do that. It's that flexible. Okay.
And how do you do that online? You change that online or something?
Yep. We have an investor portal, and I'll give you a quick tour of that when we're there, if we have a few minutes at the end. Now, we then said, let's create a liquidity feature, right? And the liquidity feature is structured very similar to a CD. The client needs all or a portion of their initial investment back. The penalty is interest only, no attack on principal. Okay. Everybody asks, if I'm in the 5-year note and I'm 4.5 years and I need to get my money out, do I lose all of the interest? The answer is yes. Don't do that. Call your financial advisor. Let's have a conversation. Let's get you across that finish line. There's got to be a way, right? Maybe it's through turning that income on. Maybe there's another investment. Let's get you across that line. Now, to offset that, Brian, we created what we call a roll-up. And a roll-up is very simple. If you're in that 1, 2, 3, or 4-year term, at the end of your term, you can lock in all of your interest and then roll up to anything above you and finish out that term at the higher interest rate. So quick example, let's say you have $100,000 in the 3-year note at 7.5. Whether you took the interest income or compounded, 100% irrelevant. Okay. End of the 3 years, client says, I like it. It's working. The income is great. I'd sure like to be in that 5-year note. I just don't want to be committed to 5 full years. Okay. At the end of 3 years, we lock in all that interest. It's now earned or ensconced. And in this example, we roll the client from the 3 to the 5, and we give them 2 years at 10.25. So they're in for a total of 5, 3 at 7.5 and 2 at 10.25. And if they had to get out in that last 2 years, it's a 2-year surrender charge, not a 5-year. It's that simple.
Right. It's that simple. Okay. Lots of flexibility to do this.
Right. And, if an investor has the moment, I'll just show you this really quick. It's kind of cool. On our investor website, take a moment and come here. We do link to buy all accounts through Morningstar Wealth, and from an advisor perspective, that helps them see the accounts. There's Mr. Elder right there as an endorser, an investor. He talks about being a part of Yrefy. I won't go to show you the whole thing, with the borrower testimonials I mentioned at the beginning of our podcast are right here. One of the things I like to talk about is this investment simulator. And this is just what it says. It's a simulator. It does not capture any data. It is simply there for the advisor and for the client to come in and kind of play with. All right. And I'm just going to give you a quick example. If a client were to put $100,000 in, you can see it immediately calculates the income down here. You can take this and slide it over and take all income, and it adjusts it right there. Or they can take and compound it, whatever they want to do. Okay, I'm going to leave it at compound, click the simulate button, and it immediately brings you up with the graphs, the pie charts, the breakdowns. So the client can come down a little further. They can break it down by month and by year and see the income or the growth. They can go down a little further from that and see all of the, this is down here is all of the tranches combined. So again, they can break it down by month and by year. So just playing with it for a second. Client, going back to my previous example, comes in here and he says, I'm going to put $100,000 into each tranche. And I want to take income from the 1, the 2, and the 3, and I wanted to compound the 4 and the 5 using my previous example. Again, it redoes all of this. This is assuming, Brian, that the client also cashes out at the end of each term. You can see that the money is coming out. Okay. And
Right.
the nice part is the advisor or the client can come in here and they can click on it by tranche 1, tranche 2. They can see them all combined. It's just a fun little calculator to come in here and play with. It's also a really good planning tool, right? If the client needs income and you want to know how much they're going to get, come in here and simulate it. These are fixed interest rates.
That's great.
So I mentioned secured collateralized, that I would come back to that. So really quickly, I'll elaborate on what secured collateralized means. What that basically means, I'll just high level it. It's a big, long legal document that basically says if Yrefy were to default on any payment to any investor, interest or principal, the entire portfolio goes to an independent third-party collateral agent. That collateral agent has one job: make the investors whole. How are they going to do it? Well, they take the portfolio and they either sell it, they collect on it, or they sell a portion and collect on the balance, whatever's in the investor's best interest. They don't really care much about us at this point because we've defaulted, right? So what will they do? Let's pretend they sold it. Well, if an investor puts $100,000 in and we're paying off debt at 35 cents on the dollar, that portfolio is going to be valued somewhere between $200,000 and $300,000. Let's say it was $250,000 just for easy math. They take an asset worth $250,000 and they sell it for 85 cents on the dollar, right? We owe the investor $100,000. We clearly are leveraged in that in the favor of our investors and ourselves very nicely. That's how it works.
Great. It's great. Well, it seems like a simple program, and you set it all up pretty nicely. And just to be official here, this is not an offer to buy or sell securities. We're just showing you the way their system works and everything. You still need to communicate with your advisor. The offering is only made by private placement. So it's not a securitized offering like an exchange traded program. It's all done privately by private placement, but investors could consider this as part of a diversified portfolio. So Laine, talking about the student loan market, what do you see for the future? We're seeing a president that's trying to just forgive everyone. Do you see any changes coming possibly from the Congress to make this a better situation so people aren't hurt so badly?
I wish that they would do something to, curb this problem. Sadly, no, I don't see much change happening. We're running into an election cycle now. So all of the fake promises of, hey, we'll forgive your student loan debt if you vote for us, all that's about to ramp up again. They couldn't get the forgiveness through the Supreme Court. So now there's all of these, they already have a bunch of income-driven repayment plan versions that are old, and they're adding more. Whatever they can do to get those votes. At the end of the day, they're not going to fix the problem by doing that. Part of what they need to do is turn the market back over to the private sector, let capitalism do what capitalism does, and allow for competition in the market, close the government purse strings, and that'll curb the college inflation rate. Right, and that's how you do it, Brian. I mean, at the end of the day, you got to get the government out. Every time they get involved in something, it gets messed up, and this is no exception.
Right. Yes, that's true. Well, and for full disclosure, we have investors who are clients of 4Star who have been involved, and it seems to be going very well. So, Laine, this is a great program, and thanks for being with us. Are there any other messages you'd like to share with the group before we finish today?
I really don't, other than, if you have questions, reach out, let us know. We're here to support 4Star, the advisors of the borrowers, the investors, and we just look forward to helping people. So, thank you for the opportunity. I'm grateful.
Thank you. Where are you guys? You're down in Arizona, right?
On Phoenix. Yep. And it's hot and muggy right now. We had a storm last night that came through in August. That does not fare well for humidity and heat. So it's kind of gross down here right now. So if ever you're down this way, come in and visit. I know you've been in the office a few times, Brian, and I appreciate you swinging through and visiting and doing your on-site, look at the office, and we're happy to invite anybody in, investors, advisors, whomever. We try and make ourselves available for whatever support you need.
Great. Well, thanks for being with us. I think this is a great, certainly an issue for America as a country, and you've started a company that solves some of these issues. and gives investors opportunities for growth as well. So it's a win-win. How many wins is there? Win.
Actually, four wins.
So,
everybody does. Yep.
That's right. Excellent. Okay, well, I'll see you soon, Laine, and thanks for being with us. And thanks to all of our listeners for being with us on today's Market Explained. We will be back again with another interview or a market commentary episode as well. So thanks again, everybody.